All right. Good morning, everybody. We made it to the end of the week. Want to be a little careful of holiday week on a big day today on the end of the month. Three different things all kind of piled together there. There was some Bitcoin news that knocked a lot of those guys down. That can tie back in quite a bit. Hut, Mara, Riot, Coin, MSTR. And then NVIDIA got hit because Baba come out flexing. Yeah, so we got a lot on the table today that after the boring start to the week, not getting anything done, trying to wrap up by the end of the month. We didn't see the window dressing that I was expecting to see either. Most analysts seem to think that today's going to be nothing and that next week on the 5th is going to be more important, mainly because the data that we're going to get today is derived from data that we've already seen, and most analysts can calculate this number for themselves, right? This PCE. So unless we get some far off number, you see how they're nearly in line. And so unless it's a surprise, this isn't going to be the shock and awe one that we're all concerned about. And the data that this uses is all done and behind us, right? So it's not really supposed to reflect anything new. And without that shock and awe, if we don't get a outlier number that freaks everybody out, then that one's not really supposed to do anything. It'll be on the 5th when we get new information that could really rock out the market. This calendar doesn't go far enough. It only goes to the 2nd. So there's always the potential, right, that the numbers come in a little off track and shakes everybody loose today, but that's not the expectation. So mind the clock, right? As always, keep track of what time it is. It's one of the best indicators that you can use. Other than that, the goal is going to be to hang on to the gains we made this week, not give any back or not give too much back, and position ourselves well into next week. The put wall was rolled up, so we can see them all on the screen without having to zoom out. It tightens everything up. You know, if we're looking for a market that did start to flex, it wouldn't have to go far before it was able to cross the lines, get through everything in its path, and have a free shot in whatever direction it wants to go. The high and the low of the week for this week carries the call wall and the put wall. So all we need is an inside week breakout. All right, just put this on a weekly here for a moment. We need a breakout of our own week. That's the week's high. That's the week's low. Not quite 100 points. Like 97, 90, 93, something like that. Napkin math. So getting outside of our own week's range, 65.15 to the upside, that's where the call wall is. It's supposed to be where we see them monetize their long calls. So basically start selling calls. And that's generally a real heavy negative weight against any sort of move beyond that to the upside. But it's not a quote resistance level like some line in the sand or a wall that you can't get past. It's just that it would be harder to climb once we got through that level. And that's generally the way it goes. But if you've been keeping track of Spot Gamma or Vol Land or Mentor Q, and they've been talking about how that upper level, the resistance is really not there. That the call wall that we see there could just be one of those, defunct walls where it just looked around and said, hey, what's the next highest premium level? Oh, it's right there, like a 0-day level. And it doesn't have a lot of strength or conviction behind it. It doesn't have a lot of money behind it. It's just a 1-day wonder. And we see that with the put wall, right? It's been moving up and down and up and down. That put wall is just flexing from one day to the next, not because they're going in and repositioning it, but because the current data expires at the end of the day and it just looks to the next day and says, what you got out there? Oh, yeah, okay, that's the new level. That call wall's been holding pretty steady, but there's nothing behind it at the moment, according to Spot Gamma and all those guys. We got into it yesterday and it did its job, certainly. Could make the argument that, that there is something there. The point being that if we can get this breakout to actually hold, it could run, because at that point there wouldn't be anything left, right? These two other red lines are what they call combo lines. Maybe they would hold something. 65.50 is on the table if we can get a breakout of yesterday's high, because we'd be through that call wall on short week Friday at the end of the month. Otherwise, we are resting on the 3-day average, 64.92 cog line. I told you guys, those numbers just keep coming back around again and again. If we break the cog line or the 3 period, we're going to the 10. Below the 10 is the volatility trigger. Then the 3-week moving average, the 20-day 0 gamma put wall, and then this week's low. And then 6,400 and away we go. Not really expecting any wild ride, right? All things considered. The base case for me today is that we go quietly into the close, keeping what we have made on the week without really giving anything back. The problem is I can clearly see an inverse TRB setup, and that owes us back to 64.30, the 20 period daily moving average, right above 0 gamma. Doesn't mean we're going to get it today, right? But I mean, it's there like a neon flashing sign. So we are closer to the lower ADR than we are the upper ADR, which implies that we should go down and hit it. The problem is we've got data, right, in about 40 minutes. We had a decent move through the kill zone. Kill zone's between 2 and 4 in the morning. That's where we finally got out of that really tight range. This is like a textbook example of lower highs and lower lows and just a gentle grind back down to a previous level. Then we got the kill zone, and well, the way opened up since then. Patterns and ADRs and pivot points won't stand in front of data, right? So we can lay out levels and we can talk about the ADR, but until we get the data, there's no reason to believe the market is going to recognize or respect or even appreciate that level. It is inside of yesterday's range, as opposed to the other one. We would need an inside day breakout to get there, and they are hedging this morning. Now, I'd already said the market really doesn't care about today's data because, well, it's a look back number. They're looking back at the data that we had already got to derive the data that we're going to get today. So the data today should not be a surprise. And yet they're worried about something. We can see that they're worried about something because they're hedging it. This isn't my opinion. I'm not guessing or assuming that they're hedging. I'm not, just making it up. We can tell that they're hedging. And if you don't have Thinkorswim and you want to know if they're hedging, as long as you've got options data, you can see if they're hedging. Now, remember, they're always hedged. So it's not like they were running around naked, not having any hedge at all. And now they've decided to armor up. They are always hedged. This is additional hedging, kind of like having insurance for your house. And then you hear that there's a hurricane coming. So you call your insurance company and you say, just for the next month, I'd really like to have some insurance for hurricanes. Triple coverage just for the month. Going to be kind of expensive, but kind of have a feeling I need it. The thing about insurance is you don't get your money back if an event doesn't happen. And with these guys, they are spending their money and it is cost, pure cost. If nothing happens, it's just going to be a loss for them. And they don't care because they'd rather spend it. So the way that you can tell if you have a market maker move is that the front expiration implied volatility average will be higher than the next expiration out. If that scenario happens, you get a market maker move, right? That's the easiest way to do it. If you want to know more about this market maker move, it was built by TD Ameritrade way back. Let me rephrase that. It was built by Tom Sosnoff when he owned Thinkorswim before he sold it to TD Ameritrade, who sold it to Schwab. Schwab now has articles on it that talk about the market maker move. They got those articles by consolidating everything that TD Ameritrade had wrote, and TD Ameritrade got the information from Tom Sosnoff and the guys like Kaufman, Rosenblum, and all the others that really put all the work in to this platform. The only reason I know so much about it is because I've read all those articles, right? And back in the day, there was like 20, 30 articles on the ticker tape, which used to be a publication at TD Ameritrade that went into detail on this thing. They never once mentioned futures, by the way. You had to just make that leap on your own. Either way, they are hedging. We can see it if we was to go inside the options chain itself. The way that this implied volatility number works is that it is looking at the trades happening in the out of the money options, the duration, the speed, the size, how close we are to expiration. It uses a square root of time formula. And with all of that, it calculates the implied volatility on the strikes that are being traded. And if a lot of trades are happening really fast on that strike, then it jacks up the out of the money implied volatility, and that ends up causing us to have the front end higher than the next expiration out. So the implied vol changes swiftly if they come in and start racking up a lot of trades on these out of the money options. And that's what changes that number up there. So we know that they're hedging this morning. The problem is, why are they hedging? This isn't supposed to be a gotcha number, right? This is supposed to be just like reviewing what we already know, like a Captain Obvious number. They should not need a hedge today. One reason I really like this indicator is because here we are thinking today's supposed to be just another walk in the park, and they're saying, uh-oh, watch out, something's wrong, and they're getting nervous and they're paying for it. It's nice to have a second opinion, especially when they're putting their money where their mouth is, because they can talk trash all they want about their position and, talk their book and try to get you to buy or sell, but we can look exactly where the money is going, and they're worried and they're spending money to hedge. Today's floor pivot is higher than yesterday's floor pivot. That's bullish. Price opened above it. That's also bullish. We hit today's pivot, so we don't have an MDP, and now we're underneath it, and we're outside of the channel. If we didn't have data coming in, like 35, 40 minutes, whatever it is, at 8:30, then I would focus more on this pivot and this channel, but we do have data, so this becomes sort of secondary to the cause. It is worth noting where the S&R lines are for the day, simply because of yesterday's move. Trying to get a feel for how wide they are. 64.83 lines up with yesterday's pivot point. That's S1. And R1 is 65.32 cog line, basically. It's actually like 65.35. And we're closer to the lower one. It's more likely that we would hit the lower one. What we want to focus on is an S1 R2. Right? Say we get data this morning, it makes us a little wicky. We come on down here and tag that S1. That sets us up for an S1 R2. Now, we was talking about a sideways Friday. It could just be an S1 R1, right? It doesn't have to do more than the ADRs, and S1 R1 is basically the ADRs. Not perfectly, but you get the idea. The other thing of note is how close the green line is versus how close the red line is. This indicator has bias and projects market direction with it. And right now it's saying up has more bias than down. That's why the R1 is farther away than S1. Just remember, this indicator isn't smart, right? It's just running the math, and the math says higher. Doesn't mean we're going to go higher. We don't have to go anywhere. Keep that in mind. But it's nice to see what the bias is, right? Especially when it lines up with our own bias, or even better, if it goes against our bias, makes us rethink and look around for more reasons to confirm our bias. Yeah, I know the word bias bothers people. I get it. We're all taught that it's bad to have a bias. Yeah, I've got a degree in psychology, so I get it. But you need a bias when it comes to trading, right? It's a good thing, not a bad thing. This isn't sociology. This is making money. So you need a bias. We've got a clean distribution this week, right? No double distribution, no big gaps in shallow areas, just a really solid distribution. But we also have something that I've been talking about that we didn't have all week. We got it now. If you can spot it, right? We got sellers. And we've been talking about this all week. If you haven't been here all week, then I get it, right? You missed the show. The idea was that we've been running up into these levels and falling back away from it with really low footprints up there, right? Why? Well, we didn't fall away because big sellers were hammering us back down. We fell away because we ran out of buyers and it just faded off. Till now. Now we've got very clear sellers up there at that 65.20 level. We didn't run out of buyers and fade off. We hit sellers. See the difference? If not, go back and watch the replays of the week. Here's a really great example. We ran up, we fell away, we have no footprint, right? There's really nothing here. We ran out of buyers. We faded away. Big difference on how we turned, right? $10-day, 30-minute volume profile and TPO. There's those buyers again that we were just talking about. This is a really ugly profile at this point. We don't have any sort of classic shape. We are still wiping out these candles that have built the current point of control. Not expecting to see a change in this thing very much, right? It could go from 68 to 75. It's just going to move up and down here a little bit. But other than that, we're not expecting to see any real change to the structure of this for a while yet. Every new candle on the right will remove a candle from the left, and the point of control candles that we're talking about removing will be removed through the day today and then into Monday. That'll wipe out what is here. But even with those gone, we've still got a lot down here, and we've got all of this work that we put in since then, right through the week this week. So not really expecting any change. Now, if we can get more volume across that high, a footprint like this that really starts to build out and we don't sell off, then we could see it run up into that 65.11, 65.10. Irene hitting highs with NVIDIA headlines. So now we've got Baba moving NVIDIA, NVIDIA moving Irene, Marvell and Dell and Gap making some moves. Oh, Caterpillar got kicked in the face. I don't know if you guys seen that or not, but I kind of got a soft spot for Caterpillar, but what a turd. I think this profile from yesterday, hey, happy birthday. Kevin's little brother's birthday is today. I didn't know he had a little brother. So I think this 5-minute profile of yesterday really highlights those sellers that I was talking about. You can see that's where the point of control was. Sure, we spent about an hour up there. So it makes sense that, that'd be where the point of control is because we spent some time here and we really didn't get much of a footprint. We spent a lot of time right here, and that's where most of the profile is at. But man, they really came in on the backside of that into the close, but it didn't sell us off, right? It wasn't like some radical violence from after hours trading or anything like that. We held it, but that was a lot of sellers, and we can see that point of control up there. It is now also a VPOC for today. It's the ones that I like to keep track of. It's a point of control that has not yet been hit now that it has been developed. So we'll just use this day for an example if you don't understand what I'm talking about. All day this day, it built the point of control right there. Then that day ended, the new day began, and since the new day began, we did not revisit that line. So it's an untouched point of control. I keep track of those. I keep them on the screen, carry them forward day after day after day until finally we get hit. So 64.56, we have not hit that level since we made that. And now we've got a new one from yesterday. Now, I'm not going to line this thing up to the tick perfect. I just don't care, right? I'm going to get close, call it good. I keep it to the nearest point. Looks like 17 would be underneath and 18 will be overhead. I think I'd rather just have 18, call it good. If you want to get it to the tick perfect, you do that. Have fun with it. I don't care. I've got enough pivots. I really don't need any more. This is not support and resistance, right? This is a level that has the expectation of a lot of trading activity. Take that what you will, right? If we call it support or resistance, we're really putting a bias into it. But if we just stick to the facts that that's where the greatest amount of trading activity happened on that day, and since it's happened, we haven't revisited that level, well, that's not my bias at all. That's just fact. This morning, we've got a really nice double distribution in the trades, and there is a complete difference between the TPO and the volume profile. I know that both of these look really like they're the same thing, but this is the TPO, right? Time, price, opportunity. Consider the one in blue, how many trades took place. And then the one in green is how much volume took place. Because we can have 5 trades with 1 contract each, then these two would match. We could have 5 trades with 100 contracts each, and then these two would look different. The point of control is up here, 6511 cog line on the TPO, but it's down here on the volume profile. Got a little bit of a disagreement here this morning. It's not bad, but it is a double distribution on both sides, and we got that shallow area. Price tends to move through shallow areas relatively easy, which we can see right there. We fell through that like knife through butter. The thing is, we can move back through that zone too. We didn't really leave any footprint behind. Shallow areas, we can move through them relatively quickly. Nice double distribution. It's a classic shape. We'll take what we can get. Look for sync between these two. We got 6492 cog line on the downside and 6511 cog line on the upside. It's really cool that it's landing on a cog line on both sides. Come on, you couldn't make that stuff up even if you were trying to. That's pretty cool. We do got a preview of next week's range, but there's a problem, right? The weeks are not the same. Next week is a short week. This range is the weekly expected move, and it is derived by 2 things, time and volatility. Well, on the one hand, generally week after week after week, this week and next week and last week are, they were all 5-day weeks. But now we're not in that situation. Now next week is a 4-day week. So we can't compare next week to the week that we have currently without a handicap because next week's a 4-day week. We're going to do it anyways. Just wanted to point that out. Also, this indicator does a horrible job when it comes to holidays. So don't be surprised if we come in next week and these lines are like 30 points apart and they're just really scrunched together. I'll show you an example of that. We've got one right back here. Contract change. It got really wonky, and it's also a 4-day week. And you can see how it's just broke, right? It's just broke. So if you come in next week and you find it like that, that's not the range, right? That's just a broken indicator. It happened. This indicator, it's thinkorswim stuff, and thinkorswim codes can do things you didn't expect them to do. Still, we can compare, right? Even with the handicap. So the range that we are looking at here with this box, that's the week that we just went through. Set it on next week's range, and we can see that it's only slightly smaller than the week that we're in right now. Boy, that tells us a lot, right? They're saying that next week's range minus a day is just slightly less than the entire range that we had this week. There's a lot of movement priced into next week at this point. The expectation for me is that through the day today, these lines are going to shrink together more because we've got really big economic data next week, and really big economic data is volatility suppressing, and these lines are derived by volatility and time. Well, we know the time component is 4 days. What we don't know is the volatility component, and whether it shrinks or grows will give us some insight into that volatility. So on Tuesday, when we come in and we take a look, because that's what we do, we measure it Friday and then we measure it usually on Monday. Tuesday is going to be our Monday next week. We'll look at what we actually got versus the projections. My base case estimate is that next week will tighten up. The range will be narrower than what we see now considerably, not because it's a short week, but because there's big economic data on the table for the 5th, which should be like Friday. Yeah. And so the market is likely to go sideways into the later part of next week while we get closer and closer to that event. So if you liked the sideways, choppy, violent week that we had waiting for NVIDIA Monday, Tuesday, and part of Wednesday, that's what's on the table for next week while we wait for Friday's data. At least that's what we're supposed to see. This at the moment is arguing against that. Kind of. I don't know. This week was a pretty big deal with NVIDIA. The last time we had a wider range is right here. That's what, like Jackson Hole? No, before Jackson Hole, right? I don't know. We'll find out. Looking at where we are with our distance to 10, we're sitting really good. So we're above the 10. We're not overbought, not overextended. It doesn't owe us anything. And we're just in a good, healthy spot. But that's the 10-day. And if we're looking at longer term trend, we're still more than 2.25% above the 10-week. We're actually closer to 2.5. It's just a nice, gentle decline. No big, sharp, sudden moves this month. We had that really violent end of July, but August has just been nice and steady, easy peasy. This is saying the entire structure is fine. It's healthy. There's no risk of violence due to some sort of mean reversion or, having traveled too far too fast, and it doesn't owe us a move. We're just good here. This is a good place to be. The trend is intact, and looking at this, there's nothing wrong with it. Just remember that this can't see news and it can't see positioning, right? So it's just looking at our distance from the 10-week. That's it. Dude, it's your birthday too? Happy birthday. And we got a lot of birthdays today. My mom's birthday is next month. And then my wife's birthday is the month after that. Long ways off. All right, looking at things that are down this morning. Bitcoin, 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 Bitcoin. Chips, thanks to Baba. Baba whacked NVIDIA, oh, and Marvell, right? You got to give credit where credit's due. Marvell down, NVIDIA down, and that is pretty much taking the rest of them down. There's also like MU. I thought MU had some news too, but that Baba flex really, kicking the legs right out from underneath NVIDIA. The Mag 7 complex is down, or the whole group, however you want to call them, the hyperscalers. Bonds are down ish. We start getting below 0.5%, and it's not what we want to keep track of. Same with jets and tech, right? They're down, just not down enough. And then more China names like the XXX China, precious metals, just they're not enough. So we want to wait to get more out of that. And banks too. Looking at what's up this morning, the VIX. The VIX is up. Uranium, China, but not enough, right? We need more out of China. This 35% is not enough. We want to see 0.5%. This is just above a quarter, so that's not going to do it. But we got a lot of China ones in here. MCHIs, China, KWeb, China. Just we need more, right? And I don't see emerging markets up there, and usually that's another China one. So it's not getting it done. Pot stocks, yes. Pot stocks continue to drive moves to the upside. They're trying to do it nice and quiet and subtle, but they're leaving footprints behind anyways. It's a next year trade, right? I've dug into the options. They've been trading January, February, and March of next year. They're just positioning now for like a change in legislation, a change in something, because they're really looking for it, right? I think there's supposed to be a drug schedule change. And by schedule, we're talking about the classification of a drug, what its schedule is. There's talk or legislation focused on the classification of these pot stocks or pot and its schedule. So there's been a lot of trading in the pot stock space where they're just accumulating and accumulating and accumulating, nice and quiet and subtle. And when they get a little ahead of themselves, it starts to pick up some. But if you're looking at this space thinking you like it, be ready to hang on to it for a while, because we don't even, we don't have the headlines yet. And they are positioning for next year, right? So, that's not going to be an early trade. And MSOS is what I have here. It's just an ETF, but you would want to look into the pot stock space. Other than the pot stocks, we got some ag, or the farm space, then China, and that's it. Bitcoin, chips, emerging markets. It's funny. I was just talking about emerging markets not showing up on the Thinkorswim one. Silver, precious metals, Mag 7, energy, generic tech, bonds. So what this scan is doing is it's asking for stocks in the S&P 100 that are up this morning at least 0.5%. None. How about down 0.5%? 14. And some of them are the Mag 7. Google, Meta, NVIDIA. Okay, a couple. So that's bearish on its own. It's a bearish start anyways. Names in the NASDAQ that are up at least 0.5%, 7. So a little bit of a divergence there between the two. Looks like telehealth stuff, pharmaceuticals, packaged software, technology services. So kind of a niche space, not really the broad hyperscalers that we're looking for. And then NASDAQ names that are down at least 0.5%, 28. 28% of the NASDAQ 100 is down at least 0.5% this morning. That's a little bearish. If that picks up speed, especially in the semiconductors, look at how many semiconductors we got in there. They're basically all down, right? Except for maybe the one with the sugar daddy, Intel. Nope, even Intel's down. So it doesn't matter that they have a sugar daddy, even they're down. The government won't save you, boys. That's just the way it's going to work, Intel. But whatever. So chips can drop the market. When we look around every day and we ask, what do we have and what could we get today? We are completely sideways, waiting on data, and we could get a breakout. But what's going to fuel it? This negativity in the tech and chip space could absolutely do it, especially when you pile on China and Bitcoin. So you want to keep your eye on those today. The other thing that could do it would be 0-day flows, but we can't see those in the pre-market, so that won't help us out. And then treasuries, bonds, commodities. So a 10-year back at 4.2. Dollar is still holding under 99. It's not even back into that 100 area. It's just sitting in this range down here doing nothing. Nothing. So just to sum this up nice and neat, we get the heck out of here. GTFO, as it always is, get out of the box. We got 15 minutes before headline news. This is the current box. It's the Globex high to the Globex low. Outside of that, you've got the RTH high and low of yesterday. And then outside of that, you've got all of yesterday, whether you count the NVIDIA drop or not. I'm not going to, right? That spike from the NVIDIA report, I'll leave that off of there. I will attribute that price action to Wednesday's price, not Thursday's price. So 3 boxes to the downside, basically 1 box to the upside, right? A little bit of a difference between these two. That's it. GTFO, you have to get out of this box to do anything else. My argument is it's very likely we just stay inside of this box. It's yesterday's price action. It doesn't owe us anything. It's been a rough week. We had to digest a lot of information with NVIDIA, and I would not be surprised at all if we just hang out here and keep what we got. Having said that, if we break, I think this sucker could move, right? There's been more and more analysts that have been looking at the options data that's been talking about strangles and straddles for a reason, that we're like just stuck in this spot, but that if we go, we go, right? And that'd be a perfect thing. Yes, I will be. That would be a perfect way to cover that extraneous move, right? So get out of the box. The data at 8:30 could give us a liquidity gap candle. Not really expecting it, but it is absolutely possible. And then that's it. Everybody, be careful, be safe, have a good weekend. I will see you all on Tuesday. Remember, it's a holiday week next week.